So let's talk about trade.
Yes.
I talk about trade a lot on this show, and I'm always making a big deal about it. I mean, it has become something that investors are really focused on, whether it's China or whether it was the surprise move on Mexico. However, in your writing, you're saying that trade has been a very minor factor. What am I getting wrong?
Well, let me say what I think the major factor is. I think the major factor is that we tightened monetary policy in 2017, 2018 predominantly. We lifted off at the end of 15, but then we stopped after 25 basis. But basically 250 basis points of tightening and 800 billion of QT came into this market in the last 2 years and has started to hit this market this year and next year. As Milton Friedman always said, monetary policy operates with long and variable lags. These are the long and variable lags. So what I think is hitting us and what is slowing us is a fairly aggressive rate hike, something in the neighborhood of 300 to 350 basis points, which, if you go back to history, has been enough to really mess things up. Back in '94, they did 300 in a rate hiking cycle. They blew up Mexico, they blew up Orange County, they blew up the agency mortgage market. I mean, this stuff really hurts. So I think trade can have an impact, but the real story of why we get a slowdown this year, why things are a little rickety, why we feel some jitters, and those jitters are a lot of EM-style jitters, maybe commodity market jitters, traditional things associated with higher interest rates and a stronger dollar, which is what we have, come from rate hike cycles. Is trade a big deal? Look, we put 25% tariffs on 200 billion worth of stuff. It's not a lot. I mean, it's a tiny amount. Did we change how people are going to build their supply chains in the future? Did we mess some things up in China? Probably, for sure. But is it really just now is that what's really at the heart of what's going on now? I don't think so. And I think through time we'll see it, but a lot of stuff's just going to get pushed around to different places. Nobody's going to be concentrated in China. You'll build a little in Vietnam. You'll have a disaster recovery location in another country, like what we have at Jefferies. We got a place we can all go in New Jersey. That'll be, if Trump decides to throw a tariff, they're all going to, disaster recovery in Vietnam, and off they go, and they're going to make their widget and sell it over, and it's just done.
Let me ask you though, David. I mean, so that makes sense to me with regard to the United States economy. Yeah. So in other words, that was the big impact was rates rather than trade. But then, does that really explain a global slowdown? And isn't that more impacted by trade and nationalization and tariffs? We're just seeing India today talking about tariffs. Is that the case?
So I actually think, in terms of China, remember, they import their monetary policy from us, right? They have a peg. By and large, 7 renminbi to the dollar, give or take. They've got this kind of funny basket, but really they're taking their cue from us. If we tighten, they feel it, which is, if you remember back to the end of 15 and 16, when we decided liftoff, that's when they did the deval, and they kind of sent shivers down the market, and we stopped for almost a year going into the election because we were very worried about what was going to happen in China if we tightened, because we were tightening for them. I think the history of the dollar in tightening cycles is that most people fund in dollars, wherever you are. Right. That's the currency that funds the world. And so when we tighten for the world.
Right.
And so I think you can explain a lot of global slowing, particularly EM and commodity currency slowing, through dollar rate hikes.
Right. So it's the
much more than
derivative
trade.
off of the rates then from
Yes.
the currency.
Absolutely.
Yeah.
Well, David, this kind of makes me think, are we overcomplicating everything here by talking about things other than monetary policy? Because it does feel like, in a lot of ways, the end and the beginning of all the action we've seen since the election could largely be explained by the tax cut and by changes in Fed policy.
Well, I may be talking my book, because that's what I write a lot about, monetary policy, and spend a lot of time doing it in my career doing it. But I think what we've seen is, particularly post-crisis, monetary policy has just become a much more important driver of financial markets and even economic activity. We give the Fed more and more power after every economic downturn. And so when a shock hits, whether it's a trade shock, whether it's a fiscal policy shock or something of the like, the monetary response has now become so big that it can dominate quite quickly. So I guess what I would say is we shouldn't stop looking at shocks, but we should always remember what the monetary policy response to that shock might be and how big it can get because of what these guys can do with their balance sheet. I mean, this is the greatest monetary policy experiment in history, right? Taking the balance sheet from 800 billion to 4.6 trillion. This is unbelievable what we've done. And the power that comes with that in the future is something that investors cannot sort of look away from and say, oh yeah, monetary policy, that doesn't matter. I mean, no, it matters. It matters a lot. And by the way, if they pull away and they don't do it, if you put somebody in charge who's not interested in being that type of policymaker, then all of a sudden these shocks could really morph into something much more serious, and you get a really
That'll
ugly
be
outcome.
interesting. But then you were also quoting Druck,
Yes.
saying that earnings matter essentially, right?
I think it's true.
That's the other part, right? I mean, that's right.
Earnings matter, multiples matter.
Yeah.
Multiples matter, and that means interest rates matter, and who sets interest rates, and how do interest rates get fed through? It's a lot of Fed policy. So I think Fed policy goes into the stock market and earnings go into the stock market. I would say both. But yes, earnings do matter.
Just to put a button on this for people that are investing, their retirement or their kids' college education. Are you overall positive on what's happening right now?
So look, I've spent a lot of time writing about a set of trading strategies that are sort of long stocks and levered long fixed income, meaning you have a risk parity type structure. It's something that the Bridgewaters and the AQRs of the world have pioneered over many decades. It's probably what's made Ray the wealthiest hedge fund guy out there. I think those strategies make a lot of sense in a world with disinflationary pressures, which technology and demographics bring, and a central bank that is a very hands-on central bank. I see both of those things continuing, so I like those risk parity strategies. I think we're in a world where rates are a great hedge for stocks, but you don't do the 60-40 trade. You do what these guys have done, which is you make that rate portfolio the same volatility as the stock portfolio, and you run that continuously. Now, it's something that the average investor would have to go to the futures market to do, or you could invest in these kinds of funds. But am I overall positive? I wouldn't have stocks without my rate hedge, and I wouldn't have rates without my stock. So I wouldn't be long bonds levered long bonds unless I had a stock position, and I wouldn't have a stock position unless I had a levered long bond position. So don't put me in the uber bull camp. I think they just have a very natural way to offset each other in times of stress, and I feel pretty good about owning that combination trade going into the next few years, if not possibly even longer.
So it depends.
It depends, but it's like peanut butter and jelly. You got to have them together. Or
yeah, I like that. Peanut butter and jelly.
Like
That's
those
good.
things.
There you go.
David Zervos is Jefferies' chief market strategist. Thanks so much for coming in. Great to
Thanks
talk
for
to you
having me.
this week, too, with the Fed.